This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have Ms. Shedlock of Sitka Pacific Capital and the Global Economic Analysis Blogspot.com joining us again this morning from Chicago. Welcome back, Mish.
A pleasure to be on the show, always, Gordon.
It's how quickly the time goes by. There's a lot to talk about, Mish, so I want to jump right into the discussion and maybe do a little bit of a whirlwind tour here around the world. But let's start with Europe. What's going on in Europe? There's a lot of things, but what's troubling you the most right now?
Well, we had these massive attacks in Paris, of course, and you look back, and then there's finger pointing. They actually captured the mastermind yesterday, the Financial Times.
I don't think they captured him, they shot him. He's in pieces.
They killed him, actually. I didn't mean captured. I do mean they killed him. But, in the wake of that, France is blaming Belgium. France pointed the finger, the big point. And said, look at all these terrorists you're harboring in Belgium. And Belgium responded, hey, we don't appreciate that. Look at all the terrorists you got in France. And of course, both statements are true. You got to back up a little bit and understand, well, why this is true. And then the French, I think, finance minister, economy minister, I'm not sure which one, came out and said today, and I just had to laugh at this. And he says, oh my gosh, if all of this is true, this may mean that all the controls in Europe aren't working. And I'm sitting there thinking, well, what controls are these? What the hell is this guy talking about? And I responded very, very sarcastically to that in my blog, but I just took it through. I said, Merkel welcomes with open arms, and so does Jean-Claude Juncker. As the EU president, all these refugees come in. So you got 1 million refugees come in. And one of these guys in the Paris attacks was fingerprinted as having come in through Greece in October. Now, there was a fake passport on him, and a lot of people were, waving the "see, I told you so," thing here. But they essentially got the story wrong. It doesn't matter whether the passport was fake or not. What mattered is whether or not he used it, to get into Europe. And if he did, that's one thing. But even if that passport was planted, Gordon, even if it was planted, they still fingerprinted this guy. Ding, ding, ding. He came in through Syria. Meanwhile, in Belgium announced today a crackdown. They didn't like the big point from France, so they said, well, we're going to do something about this. We're not going to let these people who went over and fight in the jihad in Syria back into the country. Well, there's 500 of these guys. Why were they allowed back in at all? I mean, excuse me, letting 500 people go fight alongside ISIS and not invalidating their passport and letting them back in? How crazy is that? But of course they say, oh, don't worry about this. We're going to capture them. And okay, I look at this and say, well, how many have you captured? And the answer is a few out of 500. Okay, so here we have 500 people that went over to Syria and are suspected of fighting alongside ISIS. They're back in Belgium. And just now, they think that this is a problem. Meanwhile, Merkel still has this open door policy, and she says, well, we don't want to jump to conclusion. Well, let's just do the math on this. They let in 1 million. Let's say that there was only 10,000, and let's say there were 1,000 terrorists come in. Let's just go through the math. If 1,000 terrorists out of 10,000 came in, that's 10%. If 1,000 terrorists in 100,000 came in, that would be 1%. And if 1,000 terrorists managed to get in out of 1 million, a not unreasonable number, given that ISIS actually claimed to be doing this and apparently did, that would only be 0.1%. Meanwhile, Juncker's saying, well, it's only a tiny percentage. Well, 1,000 terrorists is only 0.1% of a million, right? Right? Is my math right here? And even if it was only 100, so we have a 100% of, whatever. It's still, is it okay to let in 100 terrorists, Gordon, on the basis it's just a tiny percentage?
Yeah, we saw the damage that 8 can do, right?
Yes.
And now we've got an issue of whether we're going to let them into the states, and we'll get into that discussion. But Mish, what do you think the fallout's going to be from this economically and party wise? Because we've got some very radical parties with some radical policies in France, Germany, etc.
Well, France has already said, essentially gave the finger to Brussels and said, you know what? Because of terrorists, we're not going to be able to honor our Maastricht Treaty agreement, and we're not going to hit 3% of our budget target. Of course, they've delayed the thing 3 times in the last 3 years. In fact, I think the last time that they were ever in compliance with this, I'm not positive on this, but I believe it was something like 2002, and probably for 1 year maybe. In Germany, all the countries are in violation of this. It's just not France, but France is one of the bigger ones. And then of course in Spain, Spain has its own issues with separatists. Meanwhile, Greece is really a basket case and is going to remain a basket case. So let's not, forget about that. And of course, Greece is the point of entry for all these terrorists coming in through Syria. If there's one border that makes sense to block, it would be they shut off the border between Greece and Turkey, and also Turkey and Bulgaria, to shut it down. Bulgaria should shut it down, not let anyone in. Instead, we're letting them in, and then we're building borders between Serbia and Austria and Austria and Hungary and Germany and everywhere else. And we're putting all these borders everywhere where they don't do any good because they're already inside the EU. Crazy. But yeah,
politically,
without a doubt, I never even answered your question. Without a doubt, the ECB is gonna step on the gas again. They've threatened to do that. And so, more QE is coming. Not, it hadn't done a damn bit of good, but more is coming anyway.
But how are they going to implement it, Mish? Because they're now buying up all of the bonds that are available. They've got almost control of what assets are they going to be able to acquire.
Well, they're looking at municipal debt now, if I'm not mistaken.
I've seen some of this.
So hey. Let's go out and buy the municipal debt of random cities in Portugal and Spain, and let's call that a good idea. It's a crazy idea because we know where it's going to end eventually. It's going to end eventually in the mutualization of debt or countries leaving the Eurozone. And it's the former that Germany is worried about, but Jean-Claude Juncker wants, and I actually believe that Merkel wants as well. She just can't come out and say that now, can she, Gordon? So, meanwhile, we've got Brexit issues.
I was going to say, because you got the UK that probably in June is going to start to increase rates. That's the thinking, assuming that the Bank of England governor is telling the truth here. We got a real conflict here. You got easing in Europe, and we got tightening theoretically going to happen in Britain.
And tightening theoretically going to happen in the U.S., and God knows what's going to happen in China. So I'm actually expecting another devaluation of sorts in China, although the last one didn't do it any good. It certainly caused a shock to the financial markets. And well, what's Japan going to do? Let's switch gears and go over to Japan here.
Well, let's try and follow the logic here, because you've got mixed signals coming from all the various central banks. So we've got Japan, which is signaling even more quantitative. Well, they don't call it QE; they call it QQE now, qualitative and quantitative easing.
Oh, wow.
That's a fancy way of saying a lot more and a lot deeper.
Hey, yeah. In Japan, they're already buying 100% of the bonds that are issued. So in Japan, they've had to go on to other things, including the stock market. They're buying the Nikkei. Now, the results are nice. If you're in the Nikkei yen hedged, as I am, and that's one of the trades we've talked about before. but eventually this is going to come around to gold, and maybe we'll finish up with that thought. But for now, Japan is back in the fifth recession since what, in the last 6 years, something like that. But they say, don't worry, it's only technical, Gordon. It's only 2 quarters of decline. Don't worry. Yeah, but the year-over-year figures, if you look, the yen has plunged. Any benefit they had, well, it's not really a benefit, as you know, but a perceived benefit came from when the yen was plunging. But now, the yen plunged and is kind of stabilizing. So if it floats along in here, what's the next step? I think the yen's going to float along here until there is another next step, and we'll see what kind of repercussions there are. But meanwhile, everyone seems to have this notion that the U.S. is going to decouple from the global economy. It's as absurd now as it was that China was going to decouple from the global economy back in 2008. That was the Peter Schiff and other people argued that, and I said, well, look, guys, this is not going to happen. It doesn't even make any sense, and the idea that the U.S. is going to decouple doesn't make any sense now either. And so we'll see. We're all theorizing, but
we don't have to theorize.
We're on the right side of this one, Gordon.
Mish, we don't have to theorize. The facts are pretty clear. The slowdown is washed ashore in America, whether you want to look at the poor. When you go around the world, the slowdown is so clear and so evident, there's nothing to talk about there. And it's getting to be equivalent to the 2008 lead-in of the degree. But we're seeing it now in ports, railroad traffic, etc., in the United States. Like, there's a potential that we're going to face a recession if we're not already in one. Am I overstating that? How do you feel about
I don't think so. But in many ways, I'm not sure it'll be as bad. In some ways, it could be worse. Housing permeated every facet of the 2000 housing and real estate permeated every facet of literally everything. It was, the sole economy in 2007. It's no longer the sole economy, and housing is very illiquid. Let's say we have a, subprime auto bust, which I think is coming, and we need to talk about that. But, they can and will go out and repossess cars. It won't be the lengthy process like we saw, in mortgages. I think it's going to be more of a Japan kind of thing. Maybe there's an initial plunge in the stock market, but maybe we just drift lower, Gordon, for a number of years, like Japan did. Is that out of the question? And I think in a lot of ways that would be the most painful thing for a lot of people.
Well, if you lived through the 70s,
dip every little step of the way down, and then every dip just gets sold and sold and sold and sold. Similar to what's happened in gold, mind you, over the last 2 or 3 years. It'd be interesting if we see a reversal in that, where dips in gold are bought and everything else is sold, and that's not out of the question by any means. Given the massive bubble that we have here now, and there's no question we have a bubble here.
Mish, I believe that's what the government's trying to make happen and hopes it can somehow orchestrate. This is almost like the 70s, where we had stagnation, stagflation, and it was just like it just went on for a whole decade. I'm not saying it's the same, but they would hope for that. But my feeling is, because I've already seen the credit market reverse. And, we have the business cycle, we have the credit cycle, and we have the rate cycle. And the credit cycle is sending some pretty clear signals here that it's turned.
Especially in junk bonds, Gordon.
And exactly. And there's a whole series of whether you want to get into swaps, et cetera, but the junk bonds. So my point is, something could break, and a crisis could suddenly be upon us in a bat of an eye. You mentioned autos. Look, right now, the government now owns over $1 trillion of all those autos, like the mortgage days. The government owns them. So all of these auto leases that are going out there, they end up on the books of the federal government. those residual values that we were talking about have got to fall at some point or come back to roost, like the mortgage days. I think you're actually writing on that.
Economy going. I've actually been surprised by this because I thought back in January or February, one of the two, that the subprime auto party was going to end, and it didn't. It was like the Energizer bunny that just kept on ticking. But I read a report, from the New York Fed today talking about what's kept it fueling growth in subprime loans. And by the time the party spreads to the truly undeserving people who shouldn't get credit at all, which is where we're at now, because there's been a huge surge in auto sales to truly bad credit scores.
Mish, they now call it deep subprime. It used to be subprime. That's called deep subprime.
Term now?
That's the new technical term for those that are so far, and that's where they're being sold. But remember, the government holds the lease on that because they own the asset-backed security. And what's going to happen is, we see them every day in New England, $89 a month. Well, if that's your lease, or $119, but at some point the car comes off lease, and
halfway through you've not paid back anything on your loan, or maybe 15% of it, the way this math works. And meanwhile, the residual value of your car, on which this, let's say you buy a $20,000 car, you now owe $15,000 on a car that's worth $7,000.
With 7 and 8 year, if you bought it under 7 and 8 year financing, that's exactly what's going to happen. The car won't last as long as the payment, so you can imagine. But a third of all cars today are being leased, and so it's on 3 years you're turning that car back in. And to get those payments down, that's the residual value. And right now, you go to the used car auctions and look at the miles of cars sitting there. Dealers don't want to touch used cars. They can't move them because it's easier to get a new car. But at some point, that 3 years runs out of steam, and who's going to buy those used cars? And the residuals have got to be taken down. It's the same as the housing market collapse. It's the same scenario all over again.
It's the same scenario. We got the same. You got a stock market bubble. That's Bernanke doesn't say it this way. He said QE worked. Well, the only way QE worked, if you call this worked, is it created a bubble in assets and stimulated unsound lending and unsound hiring and unsound building of stores. And already we're seeing it. We're seeing places like Macy's. We're seeing Walmart struggling. We're seeing retailers struggle. And the amazing thing to me, though, is the Fed doesn't seem to get it. I mean, they're talking about hiking here, and of course they should hike in a sense, but actually, the better way to say it is interest rates never should have gotten as low as they did in the first place. But here we are, and the Fed is about to hike, and if they do, we're going to soon find out whether or not the economy is strong enough to take it, and what that's going to do to dollars and to the U.S. dollar, and what that's going to, what kind of impact that's going to have on manufacturing. So I don't believe that a strong dollar is necessarily an ill thing, but the Fed has so distorted the market that it's going to make it appear that way.
You watch the regional Feds very closely. What are they telling you? What are those numbers showing you?
I did an interesting study on the New York Fed just the other day. It came in negative, and it was surprisingly negative. Today, the Philadelphia Fed came out. It was barely positive, but if you look at new orders and you look at shipments, they were down. The average work week, which ought to be a really big clue, had a huge plunge in the average work week. So although the diffusion index was overall positive, and Bloomberg said that was a good thing or something like that, I'm skeptical of that overall number, and we'll see if it holds. So, but one of the amusing things to me is how optimistic economists and corporations, everyone seems to be, about the future, because in these surveys, every one of these regional surveys, they ask, the participants and their manufacturers, what they think business is going to look like 6 months from now. And so I went out and I downloaded the data and I shifted it 6 months. And I said, okay, this is what they said was going to happen 6 months ago for now. Let's move it 6 months over and measure that with what really did happen. And in 14 years of data, there were only 5 months in which the expectations, in which the actual results were what was better than what was expected 6 months ago. 5 months out of 14 years.
Mish, China. We didn't talk about China. What are you seeing there? Concerns there?
Well, no one believes the GDP growth numbers. Everyone believes that China needs to do more to stimulate. What are they going to do more to stimulate? They've had over-reliance on fixed investments. They've had over-reliance on home building, on road building, on airport building, on tunnels and bridges that don't go anywhere, and all that kind of stuff. And now they're saying, well, we need to do more of the same thing. What's really happening behind the scenes that people don't realize is that the powers that be are doing what they do. And you know what that is, Gordon? They protect themselves. So the beneficiaries of all this boom, in China was the politicians, was the state-owned enterprises, and not really the enterprise or not really the state, but rather the handful of people behind these damn things that siphoned off all this money for their own good and pawned all of these securities off to the masses where they promised these people 6% interest rate and they plowed into them. Well, we're going to see a massive number default and all that kind of crap. And what's China going to do? Well, since the politicians own this, they're probably going to cover it. But all that is malinvestment. What's it going to do? It's going to subtract from future GDP is what it's going to do. And speaking of GDP assessments, let's go back to Europe for a second. Nouriel Roubini came out and actually said the positive aspects of the attacks, of the terrorist attacks on France will be limited unless there's more of them. Now, I was somewhat astonished. I'm not surprised that some nutcases think that. I just was surprised that Nouriel Roubini would be in that class. I know he's a Keynesian, but my God, we've killed this broken window fallacy. And actually, the irony is this: Frederic Bastiat, a French economist, wrote about this in 1850. Debunking this broken window fallacy. The idea that disasters cause economic growth is actual idiocy. If it wasn't, then maybe we should bomb Chicago and see an immense amount of growth, or bomb the entire state of Illinois, or let's just sink California off into the ocean and have a nuclear war. What a better way to cause growth. If disasters cause growth, then let's have a nuclear war. The idea that you can destroy productive assets and get an economic benefit out of them is pure idiocy.
Mission, wrapping up here. Last subject, your favorite, Illinois, state of Illinois and Chicago. What's new there?
Yeah, just outside Chicago, there's a place called Illinois. Well, there's still no budget in Illinois, and they're still not paying lottery winners. And
that's what I heard. They're not paying the lottery winners.
The bickering is going on and on. So all I can say about Illinois is I'm happy the governor is holding his own and refuses to go along with tax increases that Michael Madigan, the real official governor of Illinois, wants. These guys, Madigan, the Speaker of the House, and a guy named Cullerton, John Cullerton, the President of the Senate, have been in control of Illinois for literally 3 or 4 decades, and no legislation passes without their approval, And so right now we're just sitting here. The Chicago teachers are threatening to go on strike again. And you know what? Let them all go on strike. Just fire them all. Do what Reagan did with Patco. It would be my answer. Is when all the air traffic controllers went on strike, he fired them all. And that's what we need to do. I don't know if that's legally possible here in Illinois, but that's the kind of thing that needs to happen. And so as long as Governor Ronner sticks to his guns and refuses to sign any tax increases without getting something in return, and I want major things in return. I don't know what he'll hold out for. But I would want right to work. I would want end of collective bargaining. I don't think they would ever go out for that. But if I was Ronner, those are the two things that I would most want to hold out for. And let's see if he can do it. Meanwhile, not a lot of people know this, but all these bills aren't being paid, and the lottery winners aren't being paid. But the last year, the Illinois legislature passed a law that allowed the legislatures themselves to get paid during the budget crisis, even if nothing else gets paid. And fortunately, in May, the legislature and Ronner compromised, and they passed some legislation that allowed the schools to get paid. Otherwise, kids would not be back in school because they couldn't legally pay these bills. That was probably a tactical mistake on the part of Madigan, because that is exactly what enabled Ronner to hold out for things that he wanted. Because imagine the pressure on the governor if the schools were still not open this year. So I believe Madigan made a tactical mistake on that, and hopefully Ronner will continue to hold out.
Mish, any key message you'd like to leave with our listeners, or a specific article that you've written that you strongly recommend they read?
One I just wrote yesterday. It was the Nifty 50, the Fab 5 replacing the Nifty 50. The Nifty 50 was this idea back in the 60s and early 70s that said, well, if you own these 50 stocks, well, that's all you need to do. You don't need to worry about it. When the stagflation recessions hit in the 70s, the Nifty 50 actually went down more than the overall indices. And we're seeing the same thing again. In 2000, we had the four horsemen, Dell, Microsoft, who were the other two? Intel and Cisco. They were the big four horsemen. These were the must-own stocks. You had to have these things, and they were infallible. I just pulled up the charts on them. Dell actually went private a couple of years ago. It fell from $50 to like 13. Microsoft, you'd actually be ahead of sometime last year. So after 14 years, its share price would have finally recovered to the 2000 price. And Microsoft had actually paid dividends. So on Microsoft, you'd be ahead. Cisco, Intel, and Dell, one of them I think you would be about flat, and the others you would be way behind on. So there we are, 14 years. So they talk about Japan's, dual decade of no growth. It's not going to be surprising to see that, the lost decade. We're going to see another lost decade here in the United States, because the key point here is that valuations matter. You just don't go out and buy indiscriminately buying stocks with the idea, even if you believe that the Fed is going to bail you out. Well, you know what? Stocks went down in 2000 anyway. Stocks went down in 2008 anyway. Stocks went down in Japan for over 2 decades. The idea that the Fed can prevent stocks from declining is simply fallacious. And we're going to see that again.
Well, I'm seeing holes in the buybacks because cash flows are falling because top line growth is not there. And when cash flows slow up, it's tough to keep your credit rating up and borrow money for all these buybacks. So I'm seeing weaknesses in the buybacks. and that's not.
Well, certainly, breadth is down. That's one of the things that I talked about in my post.
Breadth is down.
5 stocks accounted for all of the gains and then some in the S&P over the last year. The outside of those 5 stocks, if you remove them, the index would be down a couple percent instead of up. And if you add in, not those 5, but if you add in, say, another, 15 and look at the top 20, all the rest of them are probably net declining pretty big. So, and you look at the PEs of some of these. Amazon's like 900. Facebook considered must own it with a PE of 108 or 120 or something like that. All these must owns. It was the same thing that we heard in 2000. You have to own. These are the stocks you have to own for the long haul. Some of those aren't even in existence today.
They don't exist anymore if you really go through and look. Mish, we have to wrap. We're past our hard line. Can you tell our listeners how they could follow more of your work and your writing and your great blog?
Do a Google search for Mish. It'll take you to my blog, globaleconomicanalysis.blogspot.com. I'm working on a new blog. I'm moving to WordPress. Hopefully soon. I expected that to happen, but just do a Google search for Mish and it'll probably take you there as well when my new blog is up.
Talk to you next month.
It's a pleasure, and we'll catch you in a month.
Talk to you. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.